Hey guys, Rposada here with Coldwell Banker, HBW in Chapel Hill. As many of you guys know, I'm in the process of putting together a program designed to help community service professionals find and purchase homes in their communities. What we're seeing right now is really an unprecedented housing market, and a lot of people feel like either they can't afford to purchase a home, home ownership is not for them, or that the process is just too daunting for them to tackle, as busy as they are, right? So this program is designed to help those people that help the people in their communities, teachers, police officers, firefighters, waste management, those community service professionals, okay? And in talking with teachers primarily, we found that one of the primary issues facing teachers, in this case, but I'm sure it affects others, is the ability to understand exactly how credit works and what steps are needed to address or repair credit, right? Because, having good credit or acceptable credit is the precursor for all large purchases, whether it be a home or a car. So many things are predicated on our ability to borrow money. And so understanding how our credit scores are calculated is super important. And so what we're going to do is we're going to put together a series of conferences, discussions with service professionals that are designed at informing you about the products that are available to you, the things that you need to be focusing on, and the steps that you can be taking to prepare yourself for home ownership, with the intent of helping it seem more attainable, right? A lot of people that, primarily teachers, I'm just going to use teachers as an example because that's my background. I was a teacher for 7 years, and I talked to lots of teachers, is that they don't feel like they can purchase a home, right? Because they just don't understand the process, or they don't feel like they make enough money, or whatever it is, right? And so this whole thing is designed to counteract those emotions and that sort of mindset, right? Now, listen, homeownership isn't for everybody. And I'm not saying that by watching these things that you're going to be, able to purchase a home. There are some things that are important factors in determining whether or not you are able to purchase a home. But we're going to provide you as much information as we can from professionals to help you make that decision for yourself. Okay. And if you have any questions, feel free to email me. My contact information will be posted below in the comments, as well with Solomon's contact information, who was our speaker for this meeting when it comes to understanding your FICO score. Okay. So thanks for watching, and let me know if you have any special requests about professionals that you would like to see interviewed. Okay. Thank you.
What I'm going to be discussing today, I'm going to try and make it as simple as I can, how a FICO score is calculated, because once you understand how a FICO score is calculated, you kind of start to understand how to fluctuate your FICO score upward or downward. So the one thing that most people never understand is that the FICO scoring algorithm doesn't only come with one version. It comes with many different versions. I'm going to go back to the the credit report as I need to show you data fields. So let's get right into it. FICO scores, the difference between a FICO score and a credit score. For example, Credit Karma score is not a FICO score. You can see here freecreditreport.com. They're not giving us a FICO score. They're giving us an Experian Plus score. If you were to pull the Experian report at Free Credit Report or Annual Credit Report and request the score, you'd be getting an Experian Plus score. There's a big difference between those scores and what the banks pull. The banks are pulling FICO scores. To keep it nice and simple, a FICO score is pulling in 7 years worth of data to calculate your FICO score. Most of the other websites are pulling in 24 months worth of data. So they're missing a lot of data, which is why you have completely different scores. When I work with people who are especially trying to get the home loan process started and have not yet had their credit pulled by a lender, I always send them to the MyFICO website. Has nothing to do with me. The transaction is between you and MyFICO, but there you'll be buying a credit report that shows you Equifax, Experian, and TransUnion and gives you the FICO score. Now, let me show you what I mean by that. So there are different versions. If you go to an auto dealership and they pull your credit, and then 5 minutes later, you go to their competitor right down the road and they pull your credit, you might get two completely different FICO scores, even though they were both car dealerships that pulled it. I'm going to show you the reason for that, and plus the data fields, and then we're going to get more involved in the presentation. Here, you can see it's FICO version 8. These are your generic FICO scores. These are not industry-specific scores. So you might get these scores, from a credit card company saying, here's your FICO score is now ready for viewing. These are the scores that you would see. In these credit reports, it already tells us the percentage of utilization that you have, which is fantastic because we have to control utilization ratios. As you'll see as I'm going through the presentation, let's show it to you right now. Delinquencies equals 35% of your overall FICO score, and debt ratio, which is the use of your credit cards, that's almost identical with 30% of your FICO score. So we absolutely have to make sure that we understand that debt ratio is a very significant way to increase or decrease a FICO score. We're going to talk for very briefly about inquiries, considering more than 70% of inquiries don't even affect your FICO score. So most people they're just frozen. When someone tells them, I want to pull your credit, right away they panic, and it's unnecessary. You'll see in this credit report from MyFICO that we have all of the negative accounts that are listed across the board at all three credit bureaus. That's why the banks like this report. And now let's take a look at industry specific. You'll see here in the generic FICO score, Experian is the lowest of the three with a 602. But if this same individual went to an auto dealership, and here you can see if that dealership was using FICO Auto version 8, they're at a 616 on Experian, which also happens to be the lowest of the three. And if the next dealership was using FICO Classic, which most do, Experian drops down to 576. So there's industry-specific scores and different versions from within that industry. Here we're going to take a look at credit cards. Bank card score 8 is at 597. FICO Classic comes all the way down to a 524, which is pretty horrendous. And then let's take a look at the mortgage scores. See over here? Mortgage scores, 592, 580, and 514. So on the date this credit report was purchased, if a lender would have pulled credit, these are the scores that that lender would have seen. Now, let's go through one account. I'm going to zero in on the data fields, and you'll appreciate why as we start the presentation. You can see here, it tells us, of course, who is the creditor, the last time the account was updated, because it's possible that an account is open and active, you paid off a balance, but the creditor didn't update it for 3 months. It'll tell you that here. So that means for 3 months, the FICO scoring system isn't aware of the activity on that account or the fact that you may have paid off that balance. Here you can see is the worst delinquency that is reported, not should be, but is reporting on this account. It says here that there are none, never missed a payment. And then we have the balance. You'll understand why we're going through these individual data fields, the credit limit. If this had a credit limit, we would see a utilization ratio right below it. And then, of course, we have all the dates that the account updated and what the creditor reported to the credit bureau on that specific month. Now, here comes the more important stuff that most people never tend to focus on. The date the account was opened is one of the data fields that's pulled in to all accounts. The date it was last active, and if it were a closed account, right below it would be date closed. It tells us what kind of term is on this loan. It tells us if it's a revolving or an installment. This one is installment because it's a vehicle. The responsibility is at a joint account and so on. Now understand this. Here goes the utilization ratio. This one is a $1,200 limit, $706 balance. This is reporting a 59% utilization. So when we get back to what we were discussing here, all of this data, all of the data fields that I just showed you, the scoring software is pulling in those data fields on every single account for many different reasons. Even if the account is closed, it's still being pulled in to calculate certain things like the age of the file and so on. But all of the data that's in this credit report is predicting the statistical odds that you're going to be 90 days late or worse to any of your loan obligations, not just one particular one. So for example, if the bank is looking to lend you $700,000 to buy a property, they want to know statistically, what are the odds that you're going to default on them and their payment, or anyone else that you owe money to 90 days late or worse during the next 24 months. You can see here that the scores range in the mortgage industry, which is what we're focusing on, 300 to 850 for FICO Classic. The higher your score is, the less likely you are to default. Now, how is the score calculated? Let's simplify this a little bit. I just showed you all of the data in one account. Every single data field, that's the data that's reporting in your credit file. So if I were to pull your credit right this second, here's how the score is calculated. The scoring software is going to analyze the data that's in your credit file right this second, because that's what it can use to generate your FICO score. Whatever data is reporting in your credit file, all of it, not just some of it, it'll take that data in and calculate your FICO score. So the odds of defaulting, if you remember back in 2008, the banks are worried, if I lend out this money, well, what are the odds of them defaulting? You can see back when they were lending money to anyone back in 06, 07, didn't matter what the FICO score really was. 500 to 600 was the score range. 1 out of every 8 of those loans defaulted statistically. These days, it's in your best interest to be in the 720 and higher range, because there you're coming along the lines of being considered a high FICO achiever, plus you're much less likely to default. So the lender wants to resell these loans. They're going to sell a pool of loans and tell the investor, statistically, 1 out of every 323 of these loans will default. So that's what all this data is about. In the next 30 minutes, what I'm going to try and do, so that we don't go over on the time, I'm going to explain all 5 of these components, because you've now seen what they look like in a credit report, the data fields. If you need me to, I'll go back to the credit report and show you the data fields that the scoring software is specifically looking at on installment accounts and on revolving accounts. We're going to discuss delinquencies very quickly. Everybody kind of understands what that is, pay your bills on time, but there's more to it than that. We're going to explain very thoroughly how you should be using your credit card, because that's, again, carries almost as much weight as the delinquencies. The data fields, remember I showed you the date the account was open, the date the account was closed. That's all about the average age of your credit file. That's how the scoring software is calculating how much experience you have. I'm going to teach you what a perfect mixture of credit is, not according to me, but according to FICO, because remember, we're discussing a FICO score here. And then we're going to quickly touch on inquiries, because inquiries, again, while you should understand how they work, it's not the most serious event in your credit report unless you've gone crazy and pulled your credit. Even if you pull it 100 times in 1 year, the system stops counting after the 10th inquiry in a 12-month period. So it actually looks a lot worse than it is. When it comes to the level of delinquency, I'm going to go back to the credit report very quickly. Here you can see the level means, were you 30, 60, 90 days late? How far up that level ladder did you make it? So let me find an account that has missed payments on it, and we'll use that as our example. Here we go, a student loan, for example. So is this a revolving account, an installment account? It's clearly an installment account, not a credit card. So we're not going to be focusing on the balance on this, because it's not a credit card or a revolving account, right? So this account here is being pulled in, and now we know it was 30 days late or worse, 90 days late or worse, and the most recent 90-day late reporting is April of 2019. Now, clearly, this is a sample report. Then the next issue is the timing. When were you 30, 60, or 90 days late? Did it happen within the last 24 months, which is considered recent, or did it happen more than 24 months ago? Here you can see this is not a recent event, but it still needs to know when is the last time you missed a payment, because over here, the timing of that missed payment, you're taking a bigger deduction on your score if you were 24 months late or sooner versus if you were 30 days late 37 months ago, it would be a smaller deduction. Also calculating the missed payments. Did you miss a payment? Here, take a look here, how much the payment is on this account. It doesn't even have the scheduled payment listed here. So this data field we already know is inaccurate. It's not pushing in 100% of the data that it should be. Past due notations, they demolish FICO scores. An example of a past due notation, we'll use Macy's just as an example. You have a Macy's credit card, you have $1,000 limit, you owe them $300, and they're telling you that you have a minimum payment due on January 16th. That's 6 days from now. On January 16th, you did not make the payment yet, which means on January 17th, you become past due, which means you're possibly on your way to a 30-day late. So the past due notation is going to slam your FICO score unless you revise it. How do you correct the past due notation? You pay the bill before it becomes 30 days late. And there you may have salvaged a very big score drop. Data last activity is very important. You can see here, last activity, very important. It's when it comes to the timing of that event. You see how much data is being pulled in just to calculate your score? We're looking at collections here. Is it a collection that you're going to be 1099'd on? Let me explain what that means. We'll use American Express as an example, Bank of America as another one. You have a credit card with, say, American Express. You had a $10,000 credit limit. You owed them $9,500 and you never paid them. They took you to collections. So in we come and we start negotiating that debt. Instead of you repaying them $9,500, we get it settled down to, I'm just going to make up a number, $4,000. That means you saved $5,500 on that account. You spent $9,500, but you only repaid $4,000. American Express is going to send a 1099 for $5,500 as income to you. So these are things that you have to be made aware of, you have to be careful of, and so on. With a charge-off, well, the better the number of times that the account itself is sold. If it was sold 6 or 7 times, you're probably going to get a much better deal than if it were only sold once. The debt has much bigger value if it's fresh versus if it's 3, 4, or 5 years old. So the deals tend to become much better. But the problem with waiting for a charge-off to be sold multiple times is you're going to see multiple debt collectors reporting on the same debt. So each one of those charge-offs is going to be pulled in by the software, and it will continue to punish you as if you have a whole list of charge-offs versus just one. It used to be years ago that judgments and liens reported very easily in an individual's credit report right here. Every credit report, we're on page 24, we'll come back to that. Every credit report, as you can see, has a public record section. Most credit reports these days come in with an empty public record section. What does pop up all the time are the bankruptcies. The judgments and liens now, they've changed the requirements to have it reporting in a credit file. So it became too overwhelming for the creditors to gather all this data, or even the county clerk. So they just stopped reporting judgments and liens from most credit reports. However, just because it's not reporting in credit doesn't mean it doesn't exist. So we don't want to worry about fixing credit and then you hit another brick wall that there's a judgment open against you that nobody addressed because it wasn't in credit. A title search, a judgment and lien search is going to bring that information forward. So you should anticipate that. With tax liens, we have some very neat little techniques to make sure that a tax lien, if it's reporting in your credit report, which generally it should, you can get it removed even if it's unpaid legally by applying for a lien withdrawal. And in order to get approved for a lien withdrawal, you have to, of course, qualify the lien. It has to have a balance of less than $25,000. It has to be a federal lien, not a state lien. It's much easier to work with the feds. And you must have filed your taxes over the last 5 years and not owe any tax money from the last 5 years. So if we meet all these requirements, the IRS is going to put you in a payment plan. So for example, if you have a $16,000 balance, they'll probably spread that $16,000 over a 5-year period. And if we get all that put in place and approved by the IRS, they will give us what's called a lien withdrawal form. And that means if it's reporting in a credit report, it can no longer be reporting. So there are your delinquencies. I showed you the data fields that are very important, but these items right here are all coming from these data fields. Let's go back to 24. So these data, it's very, very important that you understand manipulating these data fields is what fluctuates your FICO score. You follow? Every time the data fields change, your score will change with it. That's the way that this game is played. Now, how long should this stuff stay on a credit report? Here it is right here. There we go. So on the bankruptcy, 10 years from the date filed, that's for Chapter 7 and 11. Chapter 13, 7 years from the date filed. The tax liens, you got to be careful with this one because a lot of people misunderstand it. It'll fall off 7 years from the date satisfied, not 7 years from the date filed. So there are some people that are waiting 6 years and 10 months thinking, well, I've got 2 more months to go and this lien won't be reporting on me anymore. That's not true. You have to get it satisfied for that 7-year clock to start ticking. And then, of course, late payments, charge-off, judgment, and inquiries is all self-explanatory right there. Now, going forward, we're going to focus on revolving debt ratio. We're going to go quickly here. Revolving debt ratio is 30% of your overall FICO score. Not a good idea to spread balances among many cards. Here's the reason for that. So at this moment, if I don't owe you any money, that means it's impossible for me to default on you. Can't default if my balance is at 0. But if I owe you $1, now there's a chance that I can default on you. Even for that $1, I can go 30, 60, 90 days late and so on. So the idea here is that when you have 5 different credit cards carrying an open balance, or something, in a lot of cases that I see, 13 and 14 credit card balances that are open on a credit report, you are far more likely to default than the average consumer who's only carrying 1 or 2 open balances, right? So you have to be careful not to spread the debt among many cards. And while a lot of people think paying credit card balances down to 50% of the credit limit works, it does work. It's better than 80% of the credit limit. But according to FICO, high FICO achievers on average allow 7% of their credit limits to revolve. Also, not the best idea in the world to open up joint accounts. It just gets too messy in the event of a divorce. If you have credit, if you're married and you want to share accounts with a spouse, it's best for each to open up their own account and add each other as an authorized user. This way, in the event of a divorce, it's as simple as removing each other as an authorized user. It's just much cleaner that way. Now, what we're going to focus on now, as I showed you earlier, the age of the credit file. I showed you the scoring software is pulling in the date the account was opened, the date of last activity, the date it was closed. All of these dates are important. But over here, I'm going to give you an example because it's important that you understand what the level of experience you have in managing your debt. So if you had an account that was open 20 years ago, and then another revolving account opened 10 years ago, and a third account opened last year, those 3 revolving accounts were opened within the last 20 years. The scoring software is going to take 20 years divided by 3. That gives you an average age of 6.7. So now to show you what that looks like in the data fields, take a look here. So this individual has the account that's oldest in their account is 8 years old, but the average age of their accounts is 4 years and 2 months. A high FICO achiever, according to FICO, has an average age of at least 12 years or more, 12 years, not 7. So that's why it's important to understand the average age of a credit file. Mix of credit. So FICO believes that the average consumer can manage the following mixture without getting themselves into too much trouble. That mixture, according to FICO, is 1 mortgage, 1 automobile, 1 home equity line of credit, no more than 3 to 5 credit cards, and then, of course, your student loans. So assuming you have this perfect mix of credit, that's worth 10% of your overall FICO score, and then you go out and you add a mortgage. So when you take that mortgage, the inquiry will dip your score a bit. If the mortgage is recorded to credit, now you've disturbed the perfect mix of credit. By adding that mortgage, you've disturbed the average age of your credit file. And then, of course, you're not affecting debt ratio because a mortgage is not a revolving account. But now you have one more account that's open to the possibility of you defaulting. You take out a mortgage, there's immediately an open balance, and you can possibly default on that open balance. So that's one more account that's at risk. But here is what FICO believes is the perfect mix of credit that the average consumer can manage without getting themselves into too much trouble. Now we're going to discuss inquiries. Inquiries that hurt. Here we go. Inquiries will affect your score for 1 full year, but they'll remain on the credit report for 2 years. So we might see a whole bunch of inquiries that were pulled 18 months ago. That doesn't mean you're being punished for those. There's no drop in the score because they stop calculating 12 months after that inquiry was pulled. It'll stop affecting your score. So inquiries are a little weird because they can cost you between 0 and 50 points. The best way to understand that is the messier your credit file is, the harder the hit you're going to take on the score for all these unnecessary inquiries. As I was telling you earlier, your score is reduced only for the first 10 inquiries, but you have to understand how to count inquiries. Otherwise, that gets confusing. So when it comes to autos and mortgages, you have a right to an unlimited number of credit pulls. So if you go to 10 different banks, they can all pull your credit because you're shopping the rate around. Now, as long as they all pull your credit in the same 45-day window, those inquiries will count as one inquiry against your score. I'm going to show you what that looks like in a minute. And then, of course, all credit card inquiries will affect your score up to 10 in the first 12-year period, right? So let's take a look at what the inquiries look like. Here we go. These are inquiries that do affect your score. This looks like a lot of inquiries here. Clearly, this person was car shopping, right? But now if you take a look just here in this red box, how many inquiries, Steve or Ray, do you think this is right here? The credit's been pulled 5 times. How many inquiries is that actually against the score? You want to take a guess or should I just show you?
I'd say it's probably just 1 because it looks like they were all pulled in the same 45-day period.
It's actually 2. These were pulled in the same 45, and this one started a new bin. So once you understand how to count inquiries, they're not that scary. This looks a lot scarier than it really is, you see? So that's why people shouldn't panic when you're talking to someone and you're trying to get them qualified. Right away, they flip out, don't pull my credit. But you have to pull their credit to tell them if they can get a loan or buy a house. So it's best if you understand how to explain it to them versus having them panic. Now we're going to take a look at inquiries that don't hurt. And this is what I was telling you earlier. Anyone who pulls their credit at myfico.com or any one of those websites, you pull your credit and pay them for a score, none of those will hurt your score. You have a right to an unlimited number of credit pulls if you're pulling it for yourself on your own file. Promotional, this is how you get all that junk mail. PRM is the way it's coded in a credit report. They buy data from the credit bureaus and then they send it out 10 million envelopes at a time. If you're applying for a job, your potential employer is going to take a look at your credit report, not so much for the score, but more for the data to see what's in that credit file. You know, for example, if you want to work on Wall Street or with an insurance company, they're not going to take you on very easily if you have 50 or 100,000 in collections, judgments, and charge-offs. So they're going to be looking at that. For those who have insurance, whether it's auto or other policies, insurance companies now use your FICO score to determine your premium. And then, of course, there's an account review. Everyone has credit cards. What they don't understand, most don't, not all, is that these credit card companies will review your account not only if you're paying them on time, but if you're missing payments to anyone else, because then they get to play with your credit limit, they get to play with your APR. That's how they do that. So let's take a look at what an inquiries page looks like. Take a look at this mess. Look at Capital One. How many times in just 3 or 4 months they pulled this individual's credit? All of these companies pulled this person's credit. This is one page of the inquiries page. Not one single one of these inquiries affects their scores. It says so right here. These inquiries do not affect your FICO score. So understanding inquiries is very important. We made it through a 4.5-hour presentation in just under 45 minutes, which is fantastic. However, There's so much more data. This is the basics of FICO. There's really no way to tell someone what you can do for them without looking at the credit report first. It just doesn't work. You have to see the credit report to know what we're dealing with. So in the event, Steve and Ray, anybody wants some help, either one of you have questions for your clients, my information's on the screen here. I'm very happy to help people through this process if they don't understand it. But remember, the key to success, I need a credit report. I can't be answering questions without that. And there you have it.
Thank you, Solomon. Liz, I got a ton of questions.
I'm ready.
And all right, awesome. So, and these a lot of, I mean, some of these questions are my own, but a lot of them are questions that I get every day from clients.
Okay.
And the first one has to do with the pulling of credit, right? So when we're talking about people applying for a mortgage or wanting to find out what their credit worthiness is or their ability to borrow is, you know, they're always presented with this problem. Like, do I have someone pull my credit?
Yeah.
Right. Only to find out that maybe I'm not qualified to buy
right
now.
Right.
So, you know, one thing I always tell people is to shop around, of course, right? Choice is important. So that 45 day is something that I know very well because that's a part of my conversation.
Right.
But on the credit side, what conversation should I be having with people when they may be nervous about having their credit pulled for a mortgage when they aren't sure if they are going to start the process or not?
That's a very easy question to answer. Don't have a bank pull their credit. Just buy it at the MyFICO website and you'll see if they're credit worthy or not right away. So, and it eliminates the inquiries. Here's the number one reason, Ray, that most people won't do what I'm suggesting. Why should I spend $59 if I can get the report for free? Well, what they don't realize is the free reports are not showing you what the banks see. So you may have one completely different set of scores on one report. Then you go to the bank, the loan officer pulls your credit. Now you're fighting with him because you think he's getting you involved in some kind of a scam. Those aren't my scores. I just pulled my credit this morning. They were much higher. So we got to be careful there with this type of lessons. Teaching people to get their reports at the MyFICO website will prepare them not only for a mortgage, it'll prepare them for an automobile, for a credit card, for student loans, and even for business loans. They see all the different industries to walk in prepared versus unprepared. So MyFICO is your answer.
What is the difference, if there is one, right, between what people will talk about as a soft pull versus a hard pull of their credit?
Yeah, soft pull are the ones that I just showed you on the inquiries page, inquiries that don't hurt, right? I showed that on the slide. Inquiries that do hurt usually come from creditors with a permissible purpose. Let me clarify what that means. I get clients that call me every single day. They tell me we were referred to you by so-and-so at the following bank. Can you pull my credit so that we can figure out, and my answer is no, I can't pull your credit. I don't have a permissible purpose. It's illegal for me to pull your credit. So I have to explain to them the option. You can either go to MyFICO and pull it yourself, which is a soft pull, or you can go to a bank, ask a million questions, not even sure if you're prepared for the loan or not, have them pull your credit. Now that's a hard pull. So, you know, that's up to you. It's not like a hard pull is going to decimate your FICO score unless you have a very, very messy credit file. Then we said, you know, an inquiry can cost you between 0 and 50 points in some cases.
So then let's say I'm interested in buying a home or a car, right? Yeah. And I'm not exactly sure what my credit looks like, right? I pay my bills on time, but I don't know, you know, how much debt I have and what that looks like, right? So it would be best for me to go to MyFICO, get my credit score for $60, right? Yeah. Bring that report to my potential creditor,
yeah,
right? And give them that information, access to that information so that I can get a better idea before I start going.
It could go a little different than that because I also understand from the lender side of the phone, they want to pull your credit because it's kind of, you know, leaning you towards working with them, which is fully understandable. I get that. But pulling your credit and going through it first is important because now when you call up someone, for example, like Steve Druck, and you tell him, hey, Steve, I pulled my credit report this morning with FICO scores. My FICO mid score is 772. So if you were to pull my credit after this conversation and you see a 772, what could you possibly offer me before he pulls the credit? You're going in, and if he needs to see the report, you could send it to him. He could see the mortgage scores are from today, that they're accurate. This way, at least it'll keep the conversation flowing. Now, of course, Steve is going to tell you about all the different programs that he has and what might best suit you. And then, of course, to move forward with him, he has to pull your credit. It's pretty simple. You can't tell him, no, you can't pull my credit, but I want your loan. Doesn't work that way.
Yeah, that makes a lot of sense. One thing that I came across, especially in my discussion with teachers, is a lot of teachers are getting divorced.
Yeah.
Right? And that divorce is having a huge impact on their credit worthiness, their ability to move forward with a home. So let's say you're talking to someone who has just been divorced, right? And their credit has taken a hit from that. Right?
Yeah.
What are some things that they could have done to, I mean, you already mentioned, not having joint accounts makes it so much easier, right?
It's a whole different world without joint accounts.
What can they do after the fact? Let's say they didn't have that foresight.
Yeah, that's a very touchy question. It's not one that's easy to answer on this phone call. Here's why. Every divorce is different. Some people want to be done with each other, nice and friendly, just please, let's move on from each other. And others, you have the threats and the I want to kill him and all that nonsense. So it really all depends on what we're dealing with. We have to take a look at a credit report from both individuals. We have to see which accounts are they linked on. Are they joint accounts, individual accounts, or authorized user accounts? Clearly, the very first thing to do on an authorized user account is to remove yourself as an authorized user and remove the other party as an authorized user. This way, that'll limit the amount of accounts we're arguing over. Then we have to give them their options. We all know that there's only one way to take a joint mortgage and a joint credit card and remove yourself from it. Steve, Ray, would you like to take a guess at what needs to be done to remove yourself from a joint account?
My guess would be you have to pay it off.
Thank you. And then close it. And after you close it, then you have to reapply and start all over again. So if the divorce is really bad, all of that needs to be done quickly because that's a lot less for them to fight over with the divorce lawyers. But if it's not that bad, if they're still friendly and they just really want to part friendly, well, then they make a timetable for paying off the credit cards and then closing them and then reopening their own individual accounts. And it's at that point that they'll understand when I tell them it's not the smartest thing to open joint accounts with anyone. Forget a spouse, even with children, it's not the smartest thing. Children are usually the ones that cause the most problem, not intentionally, unknowingly. Right, yeah. But it's my kid, I love my kid, but in the meantime, my kid screwed up my credit. What am I gonna do? So now he's suffering from it and so am I. So the idea is I open up my own account and then add my kid as an authorized user. Who's better than me? He has the credit card and I protect myself in the event of anything going on. So I'm completely controlling that account, right? Now the problem is, and because it's my account, I'm making sure the bill is getting paid every month. When you co-sign for someone, what's the whole purpose to a co-sign? The person you're co-signing for, their credit usually stinks. That's why they need a co-signer. So if you're willing to put yourself at risk from someone who's already proven they're not good at paying bills, then you should proceed with caution. So all of these things come out during a credit report review. There's a million different directions that a question can go in, but the way you and I are talking it through right now is how we have to talk it through with the person that's actually dealing with it. Is the divorce friendly or is it nasty? Will he help? Will she help? And so and so. So we really can't pinpoint what someone going through a divorce can do other than to minimize exposure, look through the credit report and create a good strategy that's going to untangle the two from one another.
So based on what we've talked about so far, and there was a lot to unpack here, but there are some key takeaways for me when it comes to advising potentially people who need to repair their debt. So I do hear a lot of people that are torn between, paying off and closing accounts.
Yeah.
Right. And that seems to be a very common philosophy. However, based on what you told me here, that potentially closing older accounts can hurt your FICO score.
Yeah.
By bringing down that average age.
Correct.
Right?
Yeah.
So is it better to have the account open because it's old, right, but has maybe a zero balance, right? Or is it better to have fewer accounts?
Yeah. The older the account is, the better off you'll be in terms of the age of your credit file. If you do want to close accounts, you would certainly, if you had to, I mean, if they're already open, they're open. If you had to, closing down the newest accounts. But what if one of those newest accounts has a $40,000 credit limit and your oldest account has only a $1,000 credit limit? Are you going to want to give up the $40,000 credit limit? Probably not. Every case is unique depending on your needs. But we also have to make sure that while meeting your needs, we don't lose sight of the fact that FICO has needs as well. The data that it's pulling in, we have to make sure it's data that's going to have a positive impact on the score. So if you start adding 5 new accounts recently, that's not really the best thing for the age of your file or for your inquiries. So there's just too many different moving parts. You really should only apply for credit that you need. You need a mortgage, obviously, to put a roof over your head. You need a car, especially if you're working and the car takes you to and from appointments, kids, to school, whatever. You don't need a Macy's credit card. You don't need that. You don't need a retailer credit card. Those credit cards are the ones that start the trouble. So you should take credit that you need, not credit that you want, unless you have very strong credit and you could afford a 10, 12 point drop for adding the new account.
That's interesting.
Yeah.
So, let's hypothetical. I move into an apartment. I need to buy a TV and a killer surround sound system. So I go ahead and I go to Best Buy, right, who is not a sponsor of this program in any way. The name just happened to pop up, right? And I get myself a credit card, right, for $5,000. I can buy my TV and my surround sound, right?
Yeah, yeah.
And now I go ahead and I pay it off on time. And now I'm sitting with this balance for Best Buy for $5,000, right? Yeah. If we're looking at, there's a continuum, right, between available debt, right, and money that's actually borrowed, correct?
Mm-hmm.
Like, what is it? Potential debt?
Well, if you have $10,000 in credit limits and you owe $5,000 against those credit limits, whether it's on 1 card or 5, you're using up 50% of your $10,000 credit limit. It's a revolving utilization ratio. But there's also a hidden issue with what you just described with this TV for $5,000 from Best Buy. So in a lot of cases, not some, what you might be describing, you could be describing what's called a consumer finance account. Any idea what that is?
No, tell me.
It's what you just mentioned. Buy this couch from us today. Don't pay us for 2 years. That's a consumer finance account. The mere presence of one of those accounts in your credit file, even if you've never missed a payment, you heard what I said, even if you never missed a payment, is a negative event because those accounts were created for subprime borrowers. You follow? So now you just went and inserted a subprime account in what could have been an A-paper account before you inserted this type of account. It's best. This is only my opinion. I'm not giving anyone financial advice or anything close to it. It's best to keep MasterCard, Visa, American Express, Discover, those accounts in your credit file. You want to make sure that you can take that credit card, whether it's MasterCard, Visa, whatever, walk into any store and shop with it. I don't know that you can use a Victoria's Secret credit card if you're shopping in Macy's. Maybe you can, maybe you can't, but I know that you can't go to Best Buy and buy a TV with your Victoria's Secret card, right?
I don't think so. I don't
think so. So what's the sense of having it? It's just they entice consumers. We'll give you 10% off your purchase here today if you apply for a credit card. But if you ask that cashier who just made you that offer, I'd love to take you up on the offer, but first, tell me how it's going to affect my credit. They'll look at you like a deer in headlights. They can't
I
explain
have
it.
no idea.
No clue. Stay away from the store cards. MasterCard, Visa, American Express, Discover is your best bet.
Heard. So if I'm faced with the idea of having a Visa, MasterCard, Discover, one of those, should I, if I've paid down enough, should I ask to reduce my credit limit at any point?
No, never. You should always ask to increase your credit limit. That's what building credit is all about, even if you don't need the increase. So if you have 4 credit cards, this month you should ask one of those 4 for an increase, then wait 3 or 4 months, ask the second one for an increase, rotate them, even if you don't need it. But you also better be careful that you know what your credit card scores are. I showed you what that looks like in the credit report earlier. You're not going to call a credit card company to increase your credit limit if your credit card FICO score is 580. That might blow up in your face. They may actually either cut your credit limit or even close the account because you force them to do an account review, you see? So you should do these things only when you're prepared. That's why I told you. The MyFICO report prepares you for every industry. You're fully prepared, at least to put up a great conversation in terms of what can the bank do for you? Because that's what it's all about. Banks are shopping for your business. You're going to go to the banks that's offering you the best deal. To get the best deal, you need strong credit. That's where it all begins. Most people forget that. You want to buy a house? Make sure you know what your credit looks like first. That's the first step the loan officer takes, isn't it? Pull the credit. Yeah. Same thing with a car, same thing with a credit card, same thing with private student loans. So there you have it. Any other?
Yeah, I mean, that's lots of good stuff. So just to take away the things that we talked about, no joint accounts, it's a mess.
Correct.
Right. If you have store cards, right, consumer credit, right, get rid of them, pay them down.
Not necessarily. No, I didn't say that. If they're open,
okay.
You have to evaluate the credit report and see what kind of an effect could it possibly have on the score if you start closing all these cards down. So the proper way to start closing down cards, ideally, first make sure that all of your credit cards have a 0 balance. This way you're not messing with the utilization ratio, right? If you have 10,000 in limits and you owe nothing against those cards, you have a 0% utilization ratio. If you close one of those cards and there's no balances on them, you still have a 0% utilization ratio. But now which one of those cards do I close? The older one, the newer one, the one in the middle? That's what the evaluation would be all about. Every report is different.
Okay, gotcha. All right, well, that's it for my questions.
Beautiful. Steve, how you doing?
Good. I am shocked at how much I literally just learned from that whole presentation. And you just made answering some of the questions that I get faced daily so much easier.
Very good. I'm happy to hear that. And yeah, anytime you have questions, call me. I have all sorts of info for you that'll help slide your deals through smoother. When people are informed, they're more comfortable. That's what I've learned in the last 17 years that I'm doing this.
Yeah, I get faced a lot. I get faced a lot with you know, I don't want to have my credit pulled. I just pulled it. And the first thing that I default to with them is, you know, obviously, where did you pull it from?
Yeah.
And, you know, and then I've been steering them straight to the MyFICO because I was like, that's, you know, I said, I pulled credit right, you know, a couple of days after somebody's pulled their FICO. And it's fine. You know, but I do get every day. I use Credit Karma, and I'm like,
I probably get it like 60 times a day, but whatever. They don't know. We got to teach them.
Yeah. You know, I mean, it's good. It's a good gauge. You can see if somebody pulled your thing. That's about it. That's about it.
All right, guys, it was a pleasure. Thanks for giving me this time tonight. I look forward to working with you. Anyone that needs help, I'm here to help you. Enjoy your evening.